of the calls that I've been fielding over the last couple of days have been looking at cash flow and how to reduce costs and how businesses can survive. But coronavirus doesn't care the fact that the 5th of April is next week. It's not going to change the tax year because of that. We still need to do our tax planning and make sure that our clients are maximising all the reliefs and allowances. One thing's for sure is that with all the government support, tax rates are going to increase at some point down the line as we need to repay this. So it's even more important that we make use of the allowances and rates available at the present time. Depending on the structure of your business, what position you're in with regards to directors' loans, mileage and things like that, there is potential to get over £25,000 out tax-free from the company, actually better than tax-free because the company will get tax relief on some of those amounts. So we have a checklist that we go through with our clients to make sure that they are maximising these reliefs, that they're claiming everything that they can claim. And one of the questions that we often get, and we've heard from new clients who come on board, is, well, my previous accountant said there was no difference between salary and dividends. So I thought I'd run through a quick example just to show you what that looked like, to show what the difference actually is, how that is calculated, and also just that really simple tax planning. Actually, it doesn't seem like much. An previous accountant might have said there's nothing there. Actually, when you run the numbers and you actually look at it, in this case, there's a significant saving. Salary versus dividends. Let's assume that the company has £50,000 profits. I'm paying myself a 50 grand salary and pay myself out that, but 50 grand is the gross wage. You've got your employer's NI on top of that. So actually, you've got a loss of almost 6 grand there. So that's not really possible. If you want to pay yourself by salary only, you'd have to take out less than £50,000. So in this example, I've calculated, please note this is on Scottish tax rates. So £50,000 profits, salary of £44,984, so almost £45,000. Gross salary, employer's NI of £5,016, so that takes you up to the 50,000. Washes out all the taxable profits, no corporation tax, no retained profits. From a personal tax point of view, though, the employee has PAYE and employee national insurance on that. Again, I'm ignoring pension here. That gives net cash in hand of 33,635 from £50,000 profit. If we look at salary and dividends for directors, so let's take the salary of 8628 for the year. That leaves us with taxable profits of 41,372, taking those away from each other. Corporation tax is calculated at 19%, so taking that off, we've then got distributable profits of 33,511. So again, a like-for-like basis, getting back to the retained profits of nil, we're going to pay all of that out via dividend. So we've got 8628 salary, that's below the personal allowance, so there's no tax on that. 33,511 of dividends. Now we've got 3872 to utilise the rest of the personal allowance. Adding those together is 12,500. We've got £2,000 dividend allowance. First £2,000 out with the personal allowance is tax free, and then the remainder of that is taxed at 7.5%. So net cash in hand from the dividends is 31,438 plus the 8628 gives 40,066. So summary, we've got £50,000 profit in all these examples. This first one we can't do because it creates a loss. This is salary only, and this is salary and dividends. So in both cases, we end up with nil profits. In this case, obviously I'm saying we can't do that one. In this case, we've got net cash in hand of 36,635, and in this one, 40,066. So a tax saving of 6,431, or extra cash in hand for the business owner. So for those accountants out there that say, oh, there's no benefit in paying yourself by salary or dividend, actually when you run the numbers, there's a £6,000 saving per director. Finally, this example is just looking at utilising the basic rate band up to the £50,000 income. So roughly £60,000 worth of profit. And in this case, it's a £9,346 saving if you've got that level of income. A really simple example as to how actually running the numbers and looking through that and making sure you're utilising all your allowances can save you a significant amount of cash. I mean, an extra £500 a month in your back pocket can have a real difference to a family's lifestyle, and maybe means you can afford that holiday at the end of the year, or get that new car that you wanted. So it's really important that you look at this before the 5th of April, as it's illegal to backdate dividends. So you can't sit down in December doing your March year-end accounts and go, oh, I'll backdate a dividend because I've got some unutilized allowance. That is illegal. It's fraud. So you have to make sure you do all your planning in the tax year. And that's why at Russell & Russell, we contact all our clients before the 5th of April to ensure that they're maximising all their reliefs and allowances available to them. Each person is going to be dependent on their individual circumstances. There might be loan interest, there might be other dividends from other sources, there might be rental property income, and so therefore you have to run the numbers for each person, which is a lot of work, but that is why we work with our clients so closely, so that we can help them take home more of what they earn, and that we should be saving them money rather than costing them money at the end of the day.